Hey guys, in today's video, I want to talk about one of my investment accounts, kind of bringing you guys behind the curtains and showing you how one of my accounts has done over the last few years since I started this account, and just going through some of the stocks I hold in this account. Hopefully you guys can kind of get a sense of how I view investing, what's important to me in my portfolio, and what I really value, and what I look at when I'm looking at what stocks to add to, what stocks to just hold on, and in rare instances, what stocks to sell out of. So for the first part of this video, we'll talk about the Canadian stocks in my portfolio. I do have a US side of this portfolio here as well. So I'll do that in a part 2 video for those of you interested. But we're going to start on the Canadian stock side. For anyone who is interested in this type of content, please quickly slam the subscribe button. We're just at about 100 followers and we're growing really quickly, so I'd really appreciate you joining me along for the journey, and there's going to be a lot more content like this, as well as deeper dives on individual stocks. So that's just my plug to subscribe, comment if you own or have any thoughts on any of the stocks that I hold. Would love to engage and interact with all of you guys. Okay, so jumping into it, we will start off on the Canadian side of my portfolio. Just looking at the portfolio overall, I started this portfolio, I guess it's about 2.5 years now, October of 2020. So just high level, the Canadian side of the portfolio is up about 9% over time. It's a portfolio that I've averaged in weekly, pretty much, if not daily in some instances, throughout the last 2 years. And I really love Wealthsimple as a platform because it enables you to kind of average in daily, weekly, because there's really no commissions. And I know in the US there's lots of options for that, but it's more rare in Canada to have that kind of opportunity to invest slowly and not needing to pay $10, $15 commissions on trades. So I've really made my Wealthsimple portfolio my main go-to spot. It is still a non-registered account, so I have TFSA, RSP, stuff like that. But I've kind of stopped adding as much to some of my other non-registered accounts in other brokerages, and have been primarily focused on this account over the last couple of years. And that's why you see it's had some very quick growth overall. But what I'm really proud of is a couple things. One, obviously this account started in 2020, and the market literally took off in about November 2020 after the vaccines got announced. And despite kind of investing throughout the inflated time period there, a good portion of money, even though the market's kind of downtrended, given the kind of stocks that I invest in, especially on the Canadian side of my portfolio, we've held up pretty nicely, and we're still up about 9% on the overall portfolio. Now, a bit of a disclaimer, I do believe in the total number here. They do include the dividends. So this is a total return, let's call it, not just capital appreciation, which as we go through some of the companies will be an important aspect of this, because lots of these stocks are dividend stocks. But still, I think I'm overall happy with the overall portfolio and how it's performed over the last number of years. Going into some of the stocks that I own here, I'm going to go through them one by one, kind of give a quick synopsis of why I like the company, where I'm at with it right now in terms of if I think it's an interesting buy or not, and how I'm allocating new money that's coming into the portfolio and reinvesting dividends that come into the account. So Allied Properties, Canadian REIT, a lot of exposure to office properties as well as some retail, and they've really been hammered if you just look at their stock chart. So if I just do a past 5 years, you'll get a pretty good sense. Used to trade 30s to 40s, up into the 50s, almost at 60 before COVID. And then as return to office seemed like it was inevitable, the stock traded back to the 40s. The fact that it seems like it's like a slower return, lots of people are staying remote, and lots of the just negative sentiment on office space in Canada, the stocks really got hit. With that being said, the FFO, which is essentially the EPS for a REIT, has stayed a pretty stagnant, like $2 to $2.25. So this company used to trade at a huge premium for having significant downtown Toronto office exposure. Currently trading, at a pretty standard REIT multiple of about 14 times, let's call it, with a lot of pipeline and development currently being built out for late this year, early 2024. So I acknowledge the risk of the office exposure, but overall, paying over a 6% dividend here has increased the dividend every year for decades. Once they're done their development this year, they're going to have a lot of capital to invest in either buybacks, reducing debt, diversifying the business in other segments of real estate if they want. So I like the risk reward, and I'll get paid 6% to wait. I really don't mind. With that being said, not a huge position for me, but one that I don't mind holding. And as it's gone down, I've actually added and nibbled a bit more here and there, and taking advantage of those 6% dividend payments that I'm getting on an annual basis from the stock. Going back, A&W royalty, I really just love the royalty model. Great source of income for the portfolio. So that's one that I've built out over the last few years in this account. Scotiabank, great Canadian bank, has really had some hard times recently, particularly with their Latin America exposure, how that market's been impacted by COVID and not bouncing back as quick. So this company does trade at a pretty low multiple here. It's calling it a 9x, and this is after about a 10% run. So I was buying this company a bit more recently at an 8x-ish. I don't own very much of it in this portfolio specifically. I don't own very much of it in this portfolio specifically, just $700. But overall, I like the Canadian banks. I don't think Scotiabank's necessarily the best one from a quality perspective, but the valuation's really strong, really enticing for the quality of bank that it is. Canadian apartment REITs, business that I really like. Long term, I think they're well positioned. We have a huge housing shortage in Canada, and they provide a lot of different tiers of housing in compact cities that have a lot of growth, both from international students, immigration, etc. And we just do not have a plan as a country in Canada to facilitate housing for all of these individuals. So obviously some short-term issues that the company's faced with interest rates, stuff like that. But overall, I sleep well at night owning, rental real estate. And I much prefer owning rental real estate through a REIT than doing it myself and dealing with, everything that comes along with that. This one's an interesting one. I have a decent amount of cash in a number of my accounts. This is probably my biggest individual cash holding that I have anywhere. It's almost $15,000. I did a separate video on this ETF, but I'm essentially getting paid a 5% annual dividend. So essentially like a variable GIC, instead of just holding cash on the sidelines. I'm getting paid a monthly distribution of, I think my last one was like $50 to $60, just to park my cash in this ETF. It doesn't move. It just holds it as a cash balance, and I get an industry leading high interest rate on it as they pool it all together and kind of leverage the scale of the ETF with banks and lenders. So I really like this for what it is. Obviously not a long-term investment, because I think market and other investments will outperform cash in the long term. But I think it's a good place to park money if you're, don't want any market risk and you're looking for opportunities. This has grown as the market's kind of jumped up 10 to 20% over the last 45, 50 days. Just as I've been a bit hesitant to take big bites out of the market. And I've been, doing smaller buys and parking more money just in cash as I wait for opportunities to come up. CN Rail, I talked about this separately in other videos on my channel. It's probably my favorite long-term stock. So I have a lot of CN Rail in all of my accounts. It's $11,000 and change here. I've done other videos pertaining to CN Rail, so I won't talk about it too much. But I just think this is a world-class business, even just looking out 5 years. Just huge moat, continues to deliver, outpacing the North American economy in terms of growth and pricing power, buying back lots of shares, increases the dividend every year, trades at a reasonable valuation at the end of the day. So I really like this name. Continuing to go down, Canadian Utilities. This is one a bit less familiar with it in terms of the crux and the details, like I know about CN Rail. But ultimately, I think they have increased their dividend for 50 straight years. Now, you're not getting CN Rail double-digit dividend increases, but you're getting, slight low single-digit increases year over year. Pretty stable, regulated business. They have some exposure outside of Canada as well. So I just think it's a good dividend-paying stock, pretty safe. I'll take my 5%-ish yield, I think. Let me just double check that. About 5% yield. That's slowly growing. And that's just continuing to feed my portfolio with cash so that I can either make 5% on that cash if I just hold it in cash, or I can invest in other opportunities as they come up. Dividend Royalty Corporation is another royalty fund, but it's not really a food royalty. They own brands like Mr. Lube, the Sutton Group for real estate, Oxford Learning Centers, stuff like that. And they have a portfolio of these diversified brands that people are paying them franchise rights and royalty rights for every dollar of revenue they take in. So I like the diversification it provides in terms of where it's stemming income from, and the fact that it's essentially an inflation hedge because it doesn't have any operating expenses that have risk of going up. It's just flowing through top line straight into my pocket every month. So that's one that I have a decent amount in this account. It's gone up pretty well on top of the 7-8% dividend it's paid me in terms of my yield on cost when I first bought in. First Capital REIT. So this is another one. I'd say in a way it's similar to Allied in the sense that they focus on very high-end real estate. The only difference is they are focused on retail real estate. So lots of properties in big downtown cores across Canada, very high-income neighborhoods, shopping malls, and grocery anchored tenants, I think, is about 70% of their rent. So relatively safe versus other retail exposure. But I like how they're so focused in the highest end neighborhoods. These aren't in go cities or second tier cities for the most part. And they have very high quality assets. So they only actually own about 150 buildings in Canada, and their market value is billions of dollars because each of these buildings are worth tens and tens of millions of dollars. They really don't play around with, small value plays in certain markets. They're focused on the best of the best. And I believe the net asset value is about 20-25% above even where the stock's trading right now. So it's a bit of a arbitration play because this management team's trying to unlock shareholder value right now. They're starting to sell off some less strategic asset, buying back lots of shares, paying out a lot more cash in dividends, really trying to maximize shareholder value. Since they do see a disconnect between reality of the value of the company and what the stock price is trading for. So I like going along for the ride. At the end of the day, the investment's backed by really strong properties that I believe in long term as well. So that's one. It's not a huge position in my overall portfolio, but it's one that I don't mind having exposure to. And once again, I get a nice dividend check every month to reinvest in whatever opportunities are top of mind. Fortis, pretty similar concept as Canadian Utilities. This one, like 95% regulated utility, increases the dividend 5-6% a year. Currently pays out about a 4% dividend. So these stocks really trade on bond yields and treasury yields. So as yields kind of go down, these become more attractive to income investors. Right now, they've kind of stagnated a bit, but they haven't gone down like tech or anything else just because their profits aren't that far into the future. They're profitable right now, and we're getting those profits paid out. But as yields go down on bonds and such, I expect like Fortis, Canadian Utilities to go up quite a bit as well. So I like that upside. I'll take my 4 to 5% dividend in the meantime as I wait, and I'll take my dividend growth as well as I try to compound the income that's being derived from my portfolio. I'm going to rush through some of these just for the sake of time, but I've talked about HDIF and Huddle on other videos as well. These are just covered call ETFs, so they provide a lot of income to me. HDIF, I think, is the most aggressive one I own because they operate under 25% leverage. So the fund actually takes out like loans of 25% of the value of the portfolio to buy stock, to do covered calls on, to generate more income relative to the interest rate they're paying on the loan as well. So that one pays about an 8.5% dividend. Huddle, I really like this one. They only write calls of up to 30% of the volume of the ETF. I'm getting paid, I think, 7.5% yield. And it's a basket of global utility stocks. So think about like telecommunication companies in Europe, US, Canada, pipelines around the world, so on and so forth. So that's one that I like, the global exposure it gives me. I also like the income it's providing me on a monthly basis. KEG Royalty, food chain in Canada, providing monthly royalty income. Same sentiment on AW.UN, Diversify the Royalty Corp, in terms of I like the fact that it just flows right through. Don't have to worry about operating expenses, employee wages, rents going up, anything like that. I'm just getting a slice of the top line. So I like that model. Life, another covered call ETF that I like holding, but it is in like the healthcare sector. So think about like big pharma companies, stuff like that, AbbVie, instead of utility companies. So just a different sector of the market. I'm getting some exposure to some of the long-term upside, even though I'm selling some of that long-term upside to get money today to reinvest in other areas of my portfolio. And I just like feel like throughout all of these cover call ETFs, the more money that I'm getting from them today, it's just giving me optionality to grow other areas of my portfolio. So yes, I'm trading off long-term growth of this money in terms of the capital I'm putting in, but I like getting that money every month that I can then deploy in new ways across my portfolio to drive long-term growth and of dividends in other ways. Northwest Healthcare is a REIT that manages lots of properties in terms of like hospitals and stuff like that around the world. It also owns a lot of hospitals and medical buildings. This one hasn't been doing too well. There's a lot behind that, so I won't get into it. So it's one that I'm continuing to monitor. I want to see another earnings report maybe and get another update before making a call to go in a big way or anything like that. But I've never sold a share of it. I've held it for many years in this account and in other accounts as well. So that may be one that I look at more in the future, as I'm pretty sure at this value it's probably paying about a 7.5% dividend. Oh, over 8% dividend. So maybe this is one that I'll look at their earnings this month and get a sense for if it's something that I'm interested in investing more. QSR, just did a video on QSR. Lots going on there, but generally, once again, primarily a royalty-based company. I think they have good long-term global expansion opportunities, great brands, defensive business, reasonable value, about 21, 22 times earnings, and they pay a good dividend. Rogers, telecom company in Canada. I like just having some telecom exposure. I think specifically the wireless business, which they're the leader in Canada, is a great business. No one's going to be canceling their cell phone plans. And as immigration grows and stuff like that, I think it's a good, maybe not high growth, but a good growth trajectory for that side of the business, which is what I mostly focus on. They also own media assets like the Toronto Blue Jays. They own about 40% of Maple Leaf Sports Entertainment. So they own a slice of the Raptors, the Leafs. They own sports rights, stuff like that. So I like having a chunk of my portfolio, at least in that, and they pay a good dividend as well. RioCan's probably my favorite REIT if I can own one. I just think they're managed really well. They own great assets. They trade at a fair value. And they just have consistently over a very long period of time been very shareholder um, friendly in just how they manage the business and what they communicate and how transparent they are in their communication. So I really like the stock. I really like the assets. It's probably, in my opinion, fairly valued right now. Their net asset value is probably mid to high 20s, but it's not one that I'm investing too much more in just because it's already a big part of my overall portfolio. With that being said, I love getting my Ryokan check every month. It's just like a nice little paycheck once a month that I get from Ryokan to reinvest in other opportunities as I see them. TD, my favorite bank in Canada in terms of quality, trades at a bit of a higher multiple than Bank of Nova Scotia, but not much. In this year, they're going to be acquiring KEG.UN as well as First Horizon in the US. So I really like that big push in the US as they've kind of not maximized, but they're very developed in the Canadian market. So I think that'll unlock a lot of growth. Hopefully they can drive a lot of synergies and they'll have a really strong EPS and organic growth here. ZDI, as I go through this portfolio, and I know I'm just going through the Canadian side, but I have a lot of Canadian exposure. And just taking a step back, Canada is like 3% of the global economy. So something I've been looking at doing more and more the last year, 2 years, is diversifying my portfolio. ZDI is one of the ways I'm doing that. It's an international dividend ETF, primarily focused on Europe, as well as like Australia, some areas in Asia, but that's kind of the geographies that this ETF plays in. I started buying right before the war situation, which wasn't the best time. But then what's great, and I think it's just a great example of how I like to manage my portfolio, is like I invest in all of these stocks for the very long term. I don't really care as long as it's not a fundamental or operational issue if these stocks go down in the short term, especially core positions that I'm holding for a reason. So as the stock kind of trended down, or the ETF rather, I was buying more and more shares in this account and other accounts, and I have a pretty healthy position in ZDI across many accounts with probably an average price of somewhere around $18. In this account, I'm a bit higher, about 19. But just I want to call it an opportunity, but use the weakness in the stock or the ETF. Still wanted the long-term exposure to markets outside of Canada and thought this was a great proxy for Europe and some of those other markets I alluded to, and doing it in a way that I'm getting that exposure, but I'm also getting a monthly dividend, which I obviously like, as you've heard me mention a couple times already. So bought and kept buying on that weakness. I know Europe's going to be fine, or hopefully is going to be fine long term, and I'm willing to make that investment on a 10% discount for something that's hopefully short term in nature. Then these are two more covered call ETFs just to wrap it up, and you'll kind of notice like the covered call ETFs flattish because I'm selling lots of the upside, but over the course of holding these stocks over the last 2 years, on ZWB, I've probably made 13% in dividends. So my total return, about 10% over 2 years, 5% a year. Nothing to write home about, but beats the market over the last year for sure. ZWC, which is total high dividend paying stocks in Canada, covered call on a basket of those. Similar story. I've actually probably got closer to 14% in dividends. So I'm probably at about a 6% annual return after everything's said and done, which once again definitely beats the market. So I don't really care too much about, just to wrap up, about capital appreciation, especially in stocks that I plan on holding for years and years, if not decades. The only reason, or in areas that I love to see capital appreciation, is if it's a byproduct of the business doing well and them increasing their dividend, providing more EPS, more cash flows, stock buybacks, which is then increasing the share price naturally. Those are things that I love to see and I love to take part in. But when things are going down based off of like negative sentiment or things that aren't fundamental in nature, for the business or operational, I usually see it as a buying opportunity unless it's a very small position of mine that I'm not overly bullish on long term necessarily, which means it probably shouldn't be in my portfolio to begin with. But those are the only cases that I don't like to see short term weakness because it may not have a long term home that I want to average into aggressively in the portfolio. Last soundbite, you kind of see I hold almost no cash in all my portfolios just because, like, if I can get 5% on cash, I don't really see the need to hold meaningful amounts of cash at 0%. So I tend to hold cash in lots of my accounts, cash the ETF, not the physical asset, just at least compounding my money on the sideline and my dry powder in one way. So that's just a heads up as to why I don't have cash here, but I do have it in the ETF. So that's just some background on the Canadian side of my portfolio in Wealthsimple. Would love to hear if you guys own any of these stocks or have any thoughts on any of these stocks. Have owned lots of these stocks for a long time. So if it's any of these stocks that you don't like, would also love to hear your thesis and hypothesis on it, just because I think it's good to kind of understand both sides of the coin on some of these names, given I plan on continuing to invest in everything you see on the screen here. But I want to thank you guys for tuning in. I know this was a bit of a long video, and I'll see you guys in the next one.